Thanks for clicking. The Canadian Real Estate Association, the CREA, has released the national sales data for the month of February, showing a real estate market that is stalling. Or, as the media puts it, things are about to pick up. Notice how the video portion of the article doesn't exactly match the upbeat headline? The markets are about to take off and Canadians are missing payments. Doesn't exactly match, does it?
Who gives a flying f***?
Yeah, and as we'll see, that's kind of the story of the day. With the CREA, the real estate industry, telling us that things are about to take off and a rate cut coming from the Bank of Canada is imminent, with other indicators telling us otherwise, like those coming from the bond market. And the disconnect between what the real estate industry is telling us and what's happening on the ground was also evident in the release of the Bank of Canada's Indicators of Financial Vulnerability, which offered a quick snapshot of the current state of the Canadian real estate market. So what I want to do today is go over Canada's real estate data for the month of February, take a look at the CREA's assessment of the current state of the real estate market, contrast that with the findings from the Bank of Canada, and then discuss what to look for next. Speaking of next, the end of the month is fast approaching and we are expecting to get the release of March's real estate data out from the local boards in a couple of weeks, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this data. Onto the data. First up, the benchmark price. The benchmark price, if you remember, that's the price of a home which represents the most popular set of features, and the price which the CREA is so excited about. The benchmark price fell in February from $719,700 to $719,400 last month, representing a 0.04% decrease. The 0.04% drop in the benchmark price is the metric that has the media so enthralled, as it represents the first time in 5 months that we didn't see a substantial drop in the benchmark price.
It's money well spent.
And the CREA's esteemed economist Sean Cathcart was particularly impressed with the slowdown in the price drops.
But it was a very sudden and abrupt end to falling prices, given that they were down 1.3% just the month before. So Matt, I got a question for you. You know, they always say you'll never use calculus after high school. It's not true. We're actually going to do that right now.
Buckle up.
Just make this as basic as possible for everyone watching.
Use small words. I'm not as bright as you.
But I digress. Let's see what Cathcart has to say.
Don't worry. Everyone will get it. So prices fell 1.3% month over month in January, which was pretty big. And then they were flat in February. So the difference in those changes, it's called the change in the change. That's in calculus. That's your second derivative. Was plus 1.3%. It's very rare for a change in a change to be that big. In fact, a positive change in the month-over-month change has only been that large or larger 3 times in the last 20 years. You want to know what they were? 1, May 2020, when the market came flying out of the first couple of months of the pandemic.
So what Cathcart is saying is that the rate of change in the benchmark price is slowing down and slowing down quickly. And the only times we've seen that rate of change slow down that fast was in May of 2020, January of 2022, April of 2023, in February of 2024. Now, we have actually seen the change in the change move that rapidly before. We saw that back in March and April of 2022, though that's when prices were dropping and the CREA didn't feel the need to break out the calculus. But that's neither here nor there. The changes in the change to which Cathcart is referring are completely explainable by external events. We had the beginning of zero rates, we had the end of zero rates, and we had the Bank of Canada pausing, all of which predictably would have led to major price changes. Are there any major exogenous factors occurring right now that could signal major price changes? Not really. Bond yields are still up from a few weeks ago, and many commentators are talking higher for longer. When Cathcart breaks out the calculus, which, as far as I can tell, he's never done before, Cathcart is stretching, which isn't exactly confidence instilling for the validity of the predictions.
That doesn't sound so good for your whole thing.
But again, I digress. Let's take a brief look at sales, which fell 3.1% since the month before. In fact, sales aren't that spectacular at all, sitting right around where they were in February's prior to COVID. In fact, if everyone is still buckled up, let's take a look at the change in the change, as sales had been increasing in January by 4.3% and have now fallen to 3.1%. That's a 7.45% change. That's the highest positive change that we've seen since April of 2022, back when the benchmark price was plunging, which, obviously, that doesn't mean anything. Now, let's take a look at the months of inventory measurement, the MOI, which is a good measurement of supply and demand. The MOI measures if no more homes came to market, how long would it take for Canada to completely run out of homes for sale? The MOI was actually up in February, sitting at 3.7 in January and bumping up to 3.8 last month. And the increase in the amount of relative inventory is also evident when we look at the sales to new listing ratio, the SNLR, which measures the number of homes that come to market compared to the number that sell. The SNLR actually fell in February, dropping from 58.3 to 55.6. Given that, according to the Bank of Canada, an SNLR between 40 and 60 is the measure of a balanced market, with the seller's market being anything over 60, a move down in the SNLR signifies that the market is stalling. Then Canada's market is moving the other way. It's moving closer to that of balanced, moving farther away from being in the favor of the seller.
I'm doing my best, Frank.
In fact, using the SNLR, this is the closest Canada's been to a balanced market for the month of February since 2019. So, we have the CREA and the media stressing the slowdown in the plunge of the benchmark price, but when we look at the data, when we look at the amount of inventory coming to the market compared to demand, we see a market that is slowing down, and slowing down compared to previous Februaries. And this disconnect between popular opinion, what we hear from the real estate industry, and what's happening on the ground was also evident in the Bank of Canada's indicators of financial vulnerabilities. First, let's take a look at the Bank of Canada's indicators of consumer expectations. Mainly, the expectation on the part of consumers that house prices will rise over the next 12 months.
Big time.
I wanted to start with this indicator as we've seen article after article, report after report, stating that buyers are just waiting on the sidelines, eager to jump into the market before prices explode. Yet, that's not what the Bank of Canada's data says. The Bank of Canada's data shows that buyers aren't buying the FOMO, with Canadians expecting house prices to rise by 4.84% over the next year, which is fairly close to where expectations were pre-pandemic. With that said, I do want to note that it's not exactly clear where the Bank of Canada is getting its expectation data.
Graphs and
Well, okay, but the bank only references itself as a source of information, which doesn't really fly. You can't just source yourself and expect Canadians to buy it as truth. You wonder where the real estate industry gets it. Even Royal LePage tells us when and how their survey was conducted. But the bank also had some real concrete data, which is good news for home buyers. The bank found that first-time home buyers and repeat home buyers have increased their share of the market. If you'll remember, back at the tail end of the pandemic, we saw article after article after article showing that real estate investors had increased their market share in the Canadian real estate market, scooping up properties and blocking out first-time home buyers. Yet, according to the data from the Bank of Canada, the investor share has fallen by 3%. It's still higher than the 20.6% average that we had pre-pandemic, but getting better nonetheless. And finally, demand. The Bank of Canada's report echoes that which we've seen so much on this channel, that demand hasn't been all that spectacular as of recent, which we saw earlier as well. So, we have the CREA, we have the media heralding the return of the hot spring real estate market, but that rhetoric doesn't exactly match the data. It doesn't match the CREA's own data, and it doesn't match the data coming from the Bank of Canada. Now, all of this isn't to say that buyers are not going to jump into the spring market. What this is to say is that the data doesn't support that narrative. The data that we have, at least, the data coming from the Bank of Canada and the CREA's own supply and demand data, doesn't support that narrative. While Canada's inflation data did come in better than expected yesterday, as we've talked about before on this channel, and as Bank of Canada Governor Tiff Macklem has said itself, 1 or 2 months does not a trend make. And as we talked about when that inflation data was released, there's a lot of pressure coming from the United States which may cause interest rates to stay elevated a lot longer than many are anticipating. The spring market could very well take off, but that's not what these indicators are saying. These indicators are saying that supply and demand is moving in the other direction. From January to February, supply and demand got worse, depending on who you are. Where you sit is where you stand. With that said, we're going to have a much better idea of the state of the real estate market when we start getting the release of March's real estate data coming out from the local boards in a couple of weeks. And we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.